New Zealand house prices have seen some of the sharpest declines across the globe. And guess what? They're only just getting started. With the central bank now forecasting that interest rates will stay higher for longer, combined with a weakening economy, we could be about to see the mother of all housing crashes. I'm Biko Konstantinos, and that's what we're going to talk about today. What do you call a Kiwi who's got one leg longer than the other? Not even, brew. Oh, shit. If you love that joke, or you thought it was just the worst, why don't you subscribe to my channel? And liking my videos helps get them shared more broadly. Hey, if you live in Australia, Canada, or any other developed world, stick around because the New Zealand housing market is like a bellwether warning to all other markets. The New Zealand housing market could give us a glimpse or a bit of a forecast of where other major markets could be headed. So let's check it out. Just this week, the Reserve Bank of New Zealand announced that they're keeping the official cash rate steady at 5.5%. But it's their comments and forecasts that we need to consider. Here's some excerpts from the August 2023 Monetary Policy Statement. The RBNZ projects that the economy will contract over the second half of 2023 as temporary supportive factors from the June quarter unwind, global growth slows, and high interest rates keep domestic demand subdued. What's contributing to the overall lower demand, which will keep the economy weak, is higher interest rates, lower house prices, and higher cost of living. Those with mortgages have seen a massive increase in their debt repayments, which reduces the amount of discretionary income for them to spend in the broader economy. But the real effect of these sharp mortgage rate hikes still hasn't fully impacted cash flow yet. And that's because we've got many people coming off low fixed rate mortgage rates, and it takes a number of months of higher rates to start reducing people's built up savings to where it really starts affecting their spending. The statement also highlighted that lower house prices also tend to lead to reduced spending by households as they feel less wealthy and have less borrowing power. So if your house was previously worth $1 million, but because prices have dropped it's now only worth $800,000, you do actually feel less wealthy, because in your mind you're thinking, if I sell my house and paid off the mortgage, this is how much I'll actually have left. And this can have a big effect on spending, because if people in general feel much wealthier, they tend to spend a lot more and a lot more freely. And as house prices reduce, people have less equity in their property, which means they can't borrow as much from the bank to do renovations or to buy other investments. And because New Zealand has seen sharp falls in their house prices, this can have a snowball effect where people start reducing their spending, protecting their capital, which then adversely affects the entire economy. Now, just like Australia and Canada, New Zealand is going full throttle on immigration. They're on track to experience the largest annual net immigration of the last century, which is equivalent to around 1.9% of the projected working age population, which is the highest proportion recorded since they started tracking it. Now, when you have a weak economy, but your population growth is surging, it means that the overall economic figures, or the gross domestic product, is artificially strengthened by the growing population, but economic growth per person actually reduces. And this is why a lot of people in New Zealand are feeling worse off, and how wealthy they feel could really start to deteriorate over the next 12 to 18 months. One of the biggest takeaways from the monetary policy statement is the cash rate forecast. You can see here that in May, the RBNZ was forecasting that rates would start falling earlier, but in this latest statement, they've pushed them out. So this purple line is the latest, and you can see the forecast starts to increase slightly from that 5.5, and this leaves things open for another potential interest rate rise, with the monetary policy review giving a 40% chance of another rise. Now, looking at the forward projection, the rate doesn't go below the current 5.5% until 2025. So that's about a year and a half away at this stage before they think interest rates might actually be cut. Now, that's pretty massive when you consider consider that the economic forecast is already very weak. Let's have a listen to Reserve Bank Governor Adrian Orr in a recent interview with Bloomberg.
What have we done? We've got an official cash rate projection 2 years out that deviates very little from 5.50%, and we think that that nicely balances the risks, the near-term risks to the upside on inflation and growth versus the more medium-term downside risks to inflation.
At this stage, the governor seems quite comfortable that 5.5 official cash rate provides a good balance by being high enough that it controls inflation, but not so high that it totally destroys the economy. Let's keep listening.
At the moment, the near-term risks are to upside inflation, i.e. inflation proving to be more sticky, a global phenomenon. We don't feel a rush to be needing to be changing rates for any time soon.
And the near-term risk is that inflation remains sticky and doesn't just continue dropping in an orderly path down to target levels. And this is indeed a global phenomenon, where headline inflations across the globe are dropping sharply, where core inflation levels are remaining elevated, and in some countries are even rising. My reading of this is that there's more chance that the next move will be an interest rate hike rather than a cut.
Output growth, particularly with the strong net inward migration into the country, could prove stronger than what we have, for the next 1 to 2 quarters ahead.
So the net migration growth could make the economy seem stronger and thus keep upward pressure on interest rates.
Well, Governor, a lot of central banks they're kind of seeing the end of their rate hikes, but they're talking a lot about higher for longer. Are you in that higher for longer camp?
Yes, I think we've been sitting there for quite some time now. We were, as you mentioned earlier in the intro, we were quick to the chase on tightening rates. We've got to this restrictive level, and we don't feel a rush to be needing to be changing rates for any time soon.
This is a huge key for the New Zealand housing market and also for other housing markets in developed nations. Will interest rates stay higher for longer? Because for the last 15 years, interest rates have actually been ultra low in most developed countries. And this has encouraged massive debt into property. It's basically artificially lifted house prices, and people have basically become dependent on those low rates and expected them to continue. But if that all now changes and rates stay higher for lengthy periods of time, a lot of that speculation and over leverage might start to reverse and house prices might come down with it. Many people who are highly leveraged into property may be trying to hold on and expecting rates to drop right back down again, and if they don't, more and more people might be forced to sell. So New Zealand are expecting interest rates to stay elevated for a lengthy period of time, and looking at this chart, you can see that New Zealand interest rates, represented here in green, were ahead of most other countries when they started rising, and were actually the first to go above 5%, really showing that they have led the way in the fight against inflation. I mentioned earlier that when house prices fall, property owners in general feel less wealthy, and this also relates to the stock market, and New Zealand's stock market has been weak. When we look here at this pre-COVID level, we can see that in the rebound after COVID it did trade above this level for a period, but ever since early 2022 has remained under that pre-COVID level, has attempted on a few occasions to rise back above it, but recently has been sold off again. So the New Zealand stock market is currently trading lower than pre-COVID levels in early 2020. So more than 3 years later, the stock market has made zero growth and has actually fallen. Now, if the stock market from here continues falling, it will definitely lead to more fear with investors, and that will most likely carry over to the property market. And if both the property market and stock market are falling, the general population will spend less because they're trying to protect their money, which means companies will be making less profit, and when that happens, they'll start laying off more people to try and reduce their expenses, which means overall unemployment in New Zealand will start rising. And if that happens, house price declines could actually accelerate. Alright, now what's gonna happen to New Zealand house prices? As we can see by this graph, the median house price in New Zealand hit a high in November 2021 at $925,000. Prices then fell sharply to $762,000 in January 2023, but since then have stabilized this year. But even in the last month from June to July have seen a slight decrease. From the peak, New Zealand house prices fell around 17.5% and have only risen a very small amount since then. And if you compare that with Australia, where median house prices only fell around 10% and have actually seen quite significant rises since then. Now, I'm not saying the Australian housing market is better because it's totally cooked, because in Australia, there's been abnormally low listings, the RBA hasn't risen rates as hard as New Zealand, and immigration levels are at astonishing record highs. But New Zealand house prices for me are more reflective of reality because the COVID boom was artificially inflated due to stimulus on steroids, government intervention, and ultra low interest rates. So when all that's removed, you should see a sharp retracement in house prices like what's happened in New Zealand. But the big question from here is, will house prices start ticking upwards, or are we going to see further declines and potentially a massive crash? Well, because we're likely to see interest rates stay higher for longer, that will eventually lead to unemployment levels starting to rise, and that's when the real pain could hit the housing market, in my opinion. Because at the moment, there hasn't been very much forced selling, but higher unemployment will definitely start to change that. Because when everyone has a job, most people are able to keep paying off their mortgages, and if they have large mortgages, they'll do anything they can to keep their house, meaning they'll do a second job or try and make additional income wherever they can. But if you lose your job and you've got a large mortgage, unless you're able to quickly get another job, it's quite likely that you'll be forced to sell your home. And if that starts happening to thousands of people all at the same time, house prices could actually crash. What's the chance of this happening? Well, it's hard to know at this stage, but if the entire global economy gets into trouble and we see most countries enter into recessions, then it definitely will become a much higher probability, in my opinion. So for me, because the New Zealand economy still hasn't felt the real impact of those ultra sharp interest rate hikes, I feel we'll see further decline in New Zealand house prices, and if local and global conditions really start to deteriorate, we could just end up seeing the mother of all housing crashes. I'm Biko Konstantinos.